So I've just seen something unbelievable from Disney stock, and in particular, the CEO, Bob Iger, has just done something impressive and Wall Street really like it. And we're going to share that with you today and why that was unbelievable and what was so impressive about it. So Disney stock is currently up 6%. It was actually up a little bit more than that, but it's pulled back. But 6% is still going to be a very good open, and that probably will lift the whole market as well. Now, Disney for me was actually one of the top 3 stocks I was trying to build into a top 3 position in the stock market crash that we had, along with Google and PayPal. So I did buy a good chunk. I never got it to the size that I wanted. I've always been saying Disney for me under $100 is definitely a buy. And we actually saw the stock get down lower than $100. It was like $84, which is crazy. And since then, it's been on a really good run. And in fact, if today opens up 6% up, it's going to be an even better run. So personally for me, I'm getting some rewards from this jump today in the share price. It just didn't stay down long enough where I could buy even more to get it into a top 3 position. But obviously that's going to really benefit me today. But why is the stock jumping up 6% after hours, even when it's been on a good run? Well, obviously they reported earnings last night. And if you actually look at the earnings, you can see here the EPS was a decent size beat, which is good. But the revenue was basically in line. When you're making 23 billion and you beat by 230 million, you go, oh, 230 million is a lot. But actually, when you look at the context of how much Disney actually made, it's only a really small amount. So the earnings were okay, and when you consider it trades at a forward P of 26, it's not the cheapest stock in the world at the moment until they ramp up the profitability a little bit more, which I think they will do. But you can see here, probably when you look at these numbers, you go, they were okay numbers from Disney. But why is the stock reacting so positively? Well, this is where Bob Iger and the CEO just pulled off a masterclass, and this was unbelievable. So you might not be aware, Bob Iger has come back as the CEO of Disney. This happened in November of last year. He left, and then in that time, Bob Chapek came in as the CEO, and he lasted around about 18 months. And eventually, Disney said, this isn't working out, we need to get Bob Iger back, and that's what they did. Now, Bob Iger had a very good track record through Disney. He obviously has been with them for a long time. He saw them through the 2008 crash. He saw them mostly through the CV crash. He's been with them a long time. He's transformed the business. He's introduced Disney Plus, and he has a very good history with Wall Street and the markets. Bob Chapek came in, and since that time frame, you look at the business has actually done okay. You look at the Disney Plus numbers, they ramped up, they overtook Netflix. However, the big difference between Bob Iger and Bob Chapek could not speak the language, or he could not say the things that Wall Street wanted to hear for the share price to do well. And you can see that translated to the point where the share price got back down to the CV low situation, and he wasn't saying the buzzwords that Wall Street wanted to hear. This is how important a CEO can be to a business. Obviously, one of the main jobs for a CEO is to make sure financially your business is performing absolutely amazing. That's one thing that you want to hear. However, there's a point that's never really talked about in the markets, but you do have to have a CEO that can impress Wall Street and say what Wall Street wants. There's a job of actually having the company financially perform amazing, but there's also a point where your CEO has to protect your share price. And in fact, your CEO can get your share price to do probably a little bit better than what it should be doing, because they're saying all the right things that Wall Street wants to hear. And this is a prime example of what we have here, where Bob Iger is saying everything that Wall Street wanted to hear. Bob Chapek didn't say the things that Wall Street wanted to hear. And sometimes when you invest into these companies, your CEO has to do a very good job, but they also need to impress Wall Street. And that came really clear in the earnings that Disney has just posted. Bob Chapek previously was basically saying, we're focusing on growth on Disney Plus, and profit really isn't the priority at the moment. And Wall Street don't like that. Wall Street want to see right now focus on efficiency and profitability. At the moment, revenue is not interested by Wall Street. They are all focusing on profitability right now. So straight away, they do not want to be hearing things like that. Bob Iger comes in, he does his first conference call, which I've just listened to since he came back into charge. And you look at the difference from that conference call that he just did. First of all, he said that we believe the work we are doing to reshape our company around creativity while reducing expenses, 100% Wall Street want to hear that right now, and will lead to sustained growth and profitability for our streaming business. This is what Wall Street wanted to hear. We've seen that before: reducing expenses, profitability, efficiency. And later on, Bob Iger went on to say that he's going to be introducing cutting 7,000 workers, and that's what Wall Street at the moment wants to hear. They want to see job cuts to save money. I said alongside that will come for a push for efficiency, one of the buzzwords at the moment for Wall Street, that targets 5.5 billion in cost savings. Reductions to non-content costs will total some 2.5 billion. He said about the cuts on the workforce, and he said on the content side, which Bob Chapek has been pushing, Bob Iger came in and said we expect to deliver approximately 3 billion in savings over the next few years, excluding sports, he said. And that's one big thing that Wall Street haven't been liking with Disney, is the costs of Disney Plus at the moment. And because of this focus on efficiency and profitability, what went totally under the radar is actually when you look at the user growth of Disney Plus. The user growth on Disney Plus was actually flat this quarter. Now you imagine that 2 years ago, if the Disney Plus growth of users came in flat, you imagine what effect that would have had on Wall Street. But Wall Street, that was in a time where it was more growth. What are we in right now? Efficiency, profitability. That is what Wall Street are looking for. Those are the key words they're looking for. And this shows you the tone of where the market was. And something that would have really negatively affected the share price a few years ago, that's not Wall Street are looking for. They're looking for that key turnaround at the moment, and that's what they were really focusing on. And they also mentioned about, potential promotion cuttings of Disney Plus as well. And a key example of using these buzzwords at the moment was Meta. Meta came out, and you listened to Mark Zuckerberg. He knew what the market wanted. He focused on the words profitability, efficiency, and you saw how the share price reacted to Meta's earnings when they were focusing on them buzzwords that Wall Street want to hear at the moment. You compare that to the likes of Google, for example. If you've ever listened to their conference call on their earnings, they said, oh yeah, we're going to cut a few jobs, and that's it. There was not much focus on profitability, efficiency, and that's why you saw Google earnings tank, and you saw something like Meta absolutely do amazing, because they focused on what Wall Street wanted at the moment. Now, them buzzwords saw the share price go up a fair amount, but this was the absolute peak of what Wall Street wanted to hear at the moment. So they said about most of the CV impacts being behind them now. If you look at the park numbers were nearly fully recovered now, which is obviously one of the profit beasts for the business. And they said that we intend to ask the board to approve the reinstatement of a dividend by the end of the calendar year. Now, this was massive because previously Disney has been focused on the growth, and now that they're focused a bit more on profitability, they want to put a dividend back into the company. They used to pay a dividend, they stopped it because of the whole CV situation, and also tied in with the investment that they're putting into Disney Plus as well, which worked out. But by the end of the year, they're looking to put another dividend back in. Now, they did say the dividend isn't going to be anything like what they had previously, which would make sense because you look at the profit that Disney are throwing off, it's currently nowhere near where they were at previously, so that dividend would not be so sustainable, so that totally makes sense. But this is what the markets want to hear: efficiency, profitability, and a dividend. At the moment, what has the market been really liking? It's been liking dividend stocks, and that is massively clear. If you look at something like the FANG stocks, for example, and we're going to add Microsoft into this list. So you got Facebook, Amazon, Apple, Netflix, Google, let's say Microsoft. Out of all them companies, which two companies have not been hurt in this time frame, in this bear market as much? Apple hasn't been hurt hardly. Microsoft hasn't been hurt hardly. What are the key things when you look at them stocks? If we just look at Apple, for example, you can see here, the stock's down 11%. This is hardly down from its highs. You've seen so many stocks like Google and Meta, for example. Meta from its highs is down nearly 51%. The likes of Google, for example, the Google's down 33%. It's nearly down triple what Apple was down. What's the difference between Apple, Microsoft, and the other FANG stocks? Apple and Microsoft pay dividends. So when the market was throwing all these other stocks out here, massively down, 50, 60, 70%, why was it looking after the likes of Apple and Microsoft, for example? I mean, Apple has just put as bad earnings in as the likes of Meta, for example, or Google, for example. Their last earnings were atrocious. But why has the market not thrown them out? Because they are profitable, but they're also collecting a dividend, and the big market focus in the last few months has been focusing on the profitability, but also if they have a dividend, okay, we're actually going to hold it through this time frame, And right now, the market is full of value investors. There's no growth investors. The growth investors left months ago. The focus on growth investors and growth investors went, right, we are getting absolutely destroyed. We're leaving the scene right here. And at the moment, the focus and the investors that are in here have been value investors. Value investors looking for profitability, really focusing on stocks that pay dividends as well. And right now, there's kind of a little bit more of a risk on market coming, but there is still a massive focus on the likes of profitability and dividends. And the fact that Disney came out and focused very much on efficiency, profitability and dividend, the market really liked that. And it pulled back in a lot of the value investors that used to invest into Disney. A lot of them value investors went, oh, it's a bit more of a growthy kind of stock now, I'm moving away from this. But this earnings report was really towards Wall Street and attracting them value investors back into the stock. And this shows you that a CEO is really important for delivering the financials of the company to do very well. But also the CEO has to be what the market wants to hear. They've got to say what the market wants to hear if they want to protect their share price and actually see their share price do well. You can have a CEO that actually has a share price that does a lot better than what it probably does deserve just because they can say the right things to Wall Street. And that was what was really unbelievable last night, was to see a company here that brought out okay earnings, but then you see an over 6% pop on them's earnings because they were saying all the right things that Wall Street wanted to hear. So yeah, overall, that's my thoughts on Disney, and just something really funny to kind of point out there, just that you might want to consider going forward. Anyway, if you could hit the like button, that's absolutely amazing. If you're new around here, subscribe and you found this video helpful, and I'll catch you in a bit.